The fastest way to understand the Iran oil crisis story is to start with geography, not ideology. A huge share of the world's crude and liquefied natural gas moves through the Strait of Hormuz, a narrow route that links Gulf producers to world markets. That is why traders, insurers, and governments react before a full shutdown ever happens. The recession fear begins the moment markets decide this is no longer just a military headline, but a risk to energy flows, transport costs, and already fragile growth. What is confirmed is narrower than the loudest headlines suggest, but still serious enough to move markets. Reporting has pointed to disruption around shipping and a rising risk premium tied to Iran's leverage over the Strait of Hormuz, while insurers, shippers, and importers price in danger, even without a complete blockade. AP's framing of Iran's toll booth effect is useful here, because it captures the reality that higher costs and delays can spread before barrels physically disappear. So the factual baseline is not total supply collapse, but a transport and confidence shock with the potential to get much worse. Markets reacted across oil, gas, and equities because investors were not only pricing fuel scarcity, they were also pricing the chance that a fresh energy spike could delay interest rate cuts, keep inflation sticky, and squeeze household spending at the same time. The Guardian's reporting matters here because it captured that cross-market move. Higher energy prices, alongside weaker stock markets, is often the signature of growth fear, not just commodity excitement. That is how an oil shock starts getting translated into recession language very quickly. The damage does not stop at the price of a barrel. If ships face delays, rerouting, or higher insurance, refiners and buyers pay more. Fuel prices climb, transport gets costlier, and businesses pass some of that on to consumers. At the same time, central banks become less comfortable easing policy if energy-driven inflation flares back up. Put those pieces together, and the economy gets hit from both sides, higher costs now and tighter financial conditions for longer. Asia is at the front of this story because many Asian economies rely heavily on both oil and LNG, making them especially sensitive to Hormuz disruption. That means the earliest pain can show up in import bills, utility costs, petrochemicals, airlines, shipping, and energy-intensive manufacturers. The United States is not insulated either because oil is globally priced and gasoline responds quickly to world benchmarks. But the immediate trade and supply exposure is more concentrated elsewhere. What starts as a route problem in the Gulf can therefore land first in Asian industry and then travel outward through prices and confidence. The key variable is persistence. Economists cited by AP and Axios drew the same line. A short burst in oil can sting, but a prolonged disruption is what starts changing hiring, investment, and central bank strategy. If crude stays elevated, gas remains expensive, and shipping and insurance costs refuse to normalize, businesses stop treating the event as temporary. That is the point where recession risk stops being a market bet and starts becoming a measurable economic drag. For anyone trying to judge whether this story is escalating or cooling, 4 signals matter most. First, whether tanker traffic through Hormuz keeps flowing or starts dropping materially. Second, whether insurance and freight premiums keep rising even on days without major military news. Third, whether oil and gas prices stay elevated for more than a brief spike. Fourth, whether central banks and major importers start openly changing their inflation and growth outlooks. Several of the most dramatic claims still depend on what happens next, not what has already happened. The unresolved question is whether disruption stays costly but manageable, or crosses into sustained supply loss and broader policy consequences. Markets can overreact in the short run, but they can also identify real pressure early. So the clean test is duration. If flows, premiums, and prices stay distorted, the recession case gets stronger. The bottom line is straightforward. Hormuz is the real center of the story. The first shock is transport and pricing, not necessarily lost supply. A drawn-out disruption is what turns fear into recession risk.